It's the final quarter of 2007. The world economy is booming, and Wall Street's trading floors are a frenzy of optimism. Billion-dollar deals are inked with confident handshakes, lavish bonuses are celebrated with champagne, and the hum of success fills the air. But deep in the backrooms of some of the world's most advanced financial firms, something unsettling begins to emerge. A low hum of data that doesn't match the party outside. Early artificial intelligence models, primitive compared to what we have today, begin to spit out troubling signals. Rising mortgage delinquencies, credit default swaps reaching levels never seen before. A dangerous mismatch between skyrocketing home values and stagnant wages. These models didn't scream the end of the world, but they whispered of cracks that could soon split wide open. In that moment, the seeds of a global economic earthquake were already visible to machines, even if the human mind refused to see them. And now, as we face a new era of AI that's smarter, faster, and more connected than ever before, a single burning question arises. If AI predicted the last crash, can it really save you from the next one? The 2008 meltdown, AI's first whispers of doom. In the mid-2000s, financial markets danced to the tune of easy money. Banks handed out mortgages like candy, and mortgage-backed securities became the golden goose of Wall Street. Homeowners believed the value of their property would rise forever, and Wall Street believed in its own invincibility. But early AI models, even those rudimentary by today's standards, began to notice that the numbers didn't add up. They analyzed loan performance data and saw that subprime borrowers were falling behind on payments faster than any historical precedent. They tracked bond market behavior and found that credit spreads were no longer in sync with economic fundamentals. And as these digital minds pieced together puzzle after puzzle, a dark picture formed. The so-called safe housing market was anything but. Yet, these early warnings didn't trigger the alarm bells they should have. Wall Street was too caught up in its own hubris, its own narrative of endless growth. Even as AI models began to paint a picture of rising default rates and looming foreclosures, decision makers dismissed them as outliers, data glitches in an otherwise perfect machine. And so, when the crisis finally erupted in 2008, it came like a tidal wave. Banks collapsing overnight, entire industries brought to their knees, and millions of families watching their dreams of homeownership vanish in the blink of an eye. In the aftermath, people wondered, did no one see this coming? The evolution of AI, from prediction to power. Since that time, AI has evolved in ways those early risk analysts could scarcely imagine. What began as simple linear regression models has grown into a vast ecosystem of neural networks and self-learning algorithms capable of parsing everything from financial statements to weather forecasts. Today's AI doesn't just track macroeconomic indicators, it reads the sentiment in a tweet, monitors foot traffic at shopping malls through satellite images, and even factors in the frequency of certain words in political speeches to gauge potential policy shifts. These machines don't sleep, don't get distracted, and don't let emotions cloud their judgment. They process an unending stream of data, seeking patterns invisible to the human eye. In the world's most powerful hedge funds and investment firms, these models have become indispensable. They don't just forecast tomorrow's market moves, they adapt in real time, recalibrating as new data flows in. If there's a sudden shift in Chinese manufacturing output, AI models can connect that dot to global supply chain stresses within seconds. If whispers of a new geopolitical flashpoint appear on encrypted message boards, AI can incorporate that risk into its models almost instantaneously. In a world where speed and scale matter, AI has become the ultimate weapon, a digital prophet of probability. The temptation of overconfidence, AI's Achilles heel. Yet, there's a danger in this power. Because even the most sophisticated AI is not immune to the fundamental chaos of human emotion. No model, no matter how advanced, can fully anticipate the moment when a flicker of doubt in one trader's mind snowballs into mass panic. No algorithm can see the exact instant when a political leader makes an irrational decision that sends shockwaves across the globe. The 2020 pandemic is proof enough. Even the best models failed to predict that a microscopic virus would shut down the entire planet. And just 2 years later, as tanks rolled across Ukraine's borders, no AI foresaw the sudden market convulsions that would follow. The lesson is clear. AI's predictions are only as good as the data it consumes. If the data doesn't account for the unpredictability of the human psyche, the fear, the greed, the collective rush to either buy or sell, then AI can't offer perfect protection. It can give you probabilities, but it can't offer you guarantees. And in that gap between what AI can predict and what it can't lies both its promise and its peril. The democratization of AI, a double-edged sword. Today, this technology is no longer the secret of Wall Street alone. Thanks to the explosion of retail investing platforms and AI-driven robo-advisors, even the average investor can access insights once reserved for the titans of finance. Apps can now help you automatically diversify your portfolio, track global macroeconomic trends, and even suggest the right time to rebalance your assets based on patterns only an AI could detect. The promise is seductive, that with AI as your co-pilot, you can finally navigate the markets like a pro. But there's a flip side to this democratization. When everyone uses the same signals and strategies, markets can become more fragile, not less. Small signals can snowball into flash crashes, just like in 2010, when a rogue algorithm wiped out nearly $1 trillion of market value in minutes. AI can protect you, but it can also amplify your risk if you don't understand how it works or how to react when it falters. And in an age of relentless volatility, that's a sobering reality to keep in mind. Will AI save you from the next crash? So, we return to that haunting question. Will AI save you from the next crash? The honest answer is complicated. AI can see things you can't. It can detect the tremors before the earthquake, the subtle ripples of fear before the wave of panic. It can give you a map of probabilities, a glimpse of where the danger lies. But it can't stop the panic from taking hold, or the sudden shocks that come from nowhere. In that sense, AI is more like a lighthouse on a foggy shore than a bulletproof vest. It can show you the rocks ahead, but it can't calm the storm itself. And so, as we stand on the edge of a new financial horizon, it's not about putting blind faith in these digital prophets. It's about learning to read their signals wisely, to use them as a compass rather than a crystal ball. Because the market isn't just numbers on a screen. It's a mirror of our collective hopes and fears, a dance of data and human nature that no machine can fully tame. AI predicted the last crash, but will it save you from the next one? The answer is yours to decide.